Today we are going to talk about why you should be your own bank. And it might seem a little odd, like, well, what would I want to do that? I bank at Bank of America, Wells Fargo, or whatever else that's out there. But here's the thing. When you're banking with someone else, guess who's really on the winning side of the equation? The banks. That's right. Because they're using your funds to make money. So to kind of give you an example of how it really works is that there's this thing called fractional lending. So let's say that you deposit $10,000 and let's say the ratio is 1 to 10. That means that they're going to loan that money out, guess what? 10 times over. So they're loaning out $100,000 as a result of it. And so they're doing this over and over and over. So let's get into how they make the money. So they do that. Now, then let's say you get a credit card from that bank. Well, think about that. Let's say your interest rate was 10%, 20%, whatever it is. So you deposit your money and then you get a banking product from them to borrow money from them where they charge you a large amount of interest for the privilege of doing so. That's banking. And no one really thinks about it. No one blinks an eye like, well, it's convenient. So what, I'm paying a little bit of interest. And you go about doing your normal day-to-day things. The same thing happens when you buy a car. Like, oh, I'm getting a great rate for money that's in the bank that you put there, and they're lending back to you. When you go and buy a mortgage, well, you're borrowing a larger amount. Guess what? It operates just like a credit card. So you're paying interest over the whole thing. And when you listen to financial experts out there, what do you hear? Pay off debts, try to avoid interest. Yet everything that people are telling you to do using these different financial products in the marketplace is doing what? You're paying interest to somebody else. So when it comes down to becoming your own bank, what does it actually mean? This means that you're literally doing that, but you're doing it through a specific vehicle known as life insurance. Now, some people might hear the word life insurance. Oh no, not going to benefit with that until I'm gone. Wrong. And that's if it's just set up in the old-fashioned way, like you kick the bucket and you kind of get those types of benefits. But what you really do is this. You fund the policy so it builds up a cash value that you can leverage now. And this is where the juicy good parts come in. When you borrow from a policy, here's what happens. It doesn't stop working for you. That's right. So let's just say that you have $10,000 in it and you borrow $8,000 because you had to repair the roof of your house or you want to take a vacation or whatever. Well, guess what happens? For one, you're paying a lower interest rate. It's simple interest. And I'll talk about simple interest versus compounding interest in a different video. But here's what happens. That $10,000, that's your actual cash balance in your account. That's the amount that's still making money, even though you borrowed $8,000. So let's just say, as an example, your account made 10% that year. Well, even though you had $8,000 sitting out, well, now your account value into the year becomes, guess what? $11,000, and you borrow this, so you're paying it back, and then it just keeps doing this over and over and over again. So no matter what, that balance is growing, so you're getting further and further ahead, and that's what you really want to be doing. That's the advantage when you're becoming your own bank. So let's look at a couple examples of where this is super powerful. Let's just take buying a car. What do most people do? When you buy a car the right way, here's what happens. If you took $20,000 out of a policy that you had, and then you paid it back over 5 years, well, your account has increased in value. So let's say your account was a little over $20,000, you borrowed that, and you paid it back in 5 years. Let's say it was worth $25,000, but you still borrowed $20,000 because your car was worth $10,000 into it. So then you got a $30,000 car. Well, your car payment is still, guess what? The amount for a $20,000 car. And then you keep repeating this process. But this is where the best part comes in. Even though you're borrowing from yourself, your account value is increasing. So think about that for a moment. You're buying a car, you're paying yourself back, and your account value is growing. What happens when you do it the traditional way? If, let's say, you're getting financing. Well, let's say that you finance it and it was $24,000 total with interest. well, then you're in the hole and you're working your way back up to zero. And then you're trading the car, and guess what you're doing? You're back here. So you're always working back up, and you're never building up that equity. The same thing happens when you hear financial gurus saying, well, pay cash for the car. Well, you're losing the buying power of that cash. So let's say you get $20,000 in cash. You wrote a check, bam, done. Guess what happens? You're now down at zero, and you have to build back up again. Bam, you're down at zero. That is why the old ways of doing it don't work, and why you have to become your own bank, because we're making these purchases each and every day, but because we're not doing it in a cash efficient manner, someone else is benefiting. That's the banks, of the different financial institutions for the lending. All those people are benefiting from your hard-earned dollars. What this is doing by becoming your own bank, you're recapturing a good chunk of that. So you're taking those funds and putting them back into your wallet, putting back into your family's future. And that's what you want to be doing, because it's going to make a big difference. And the short term is like, okay, well, it's growing a little bit, but long term, this is where the significant impact is. So to use that example with the car, if someone started when they're 25 and they did this, by the time, let's say they're age 70, if the market was doing, like, let's say a little under 5.5% a year, you're talking about $480,000, give or take, depending on the size of the policy, that's growing. Compare this to if you are just paying cash for a car. Well, if you bought 10 cars in that period of time, $240,000 just went out the door. If you're financing, guess what? $240,000 went out the door with nothing going back into your pocket. By doing it this way, you're coming out ahead. And that's what I want you to be thinking about, of why you have to become your own bank. It's taking these actions so you can be coming out ahead each and every year in your life, because you can do this for your car, for major purchases, for vacations, for your mortgage, for your children's college education. I mean, the list goes on and on of the things that you can be doing this in your life for. It just comes down to making the conscious decision of what you want to make happen so you can have the things that you want. So what I challenge you to do is take a step back and ask yourself, do I want the financial institutions to get all of my money, to take advantage of me, or do I want to win with this? That's what I want you to ask yourself. And then go ahead and click the link below this video so we can set up a time to talk of how we can implement this for you and your family so you can come out ahead. I look forward to speaking with you.